You're now live. This is what it says to me, so I'll get started. And welcome to everybody. I'm doing my usual call once a week on your questions as budding property investors, asking me my advice or my stories. I have been 30 years in this business, and so at this stage, I think I've picked up a couple of ideas as to what's going on. Hey guys, welcome over in Instagram, in TikTok. Hope you guys are having a good evening. So we're talking about, hi Gavin, how are you? It's good to have you guys. And so let me have any questions you have. I'm going to be jumping on to questions about real estate, property, investing in general, whatever it is that you want to ask about. I have plenty of stories to tell, lots of stuff going on at the moment. And the market is, it's an interesting market at the moment. We're in August, and August is always pretty quiet, generally speaking. And so not a lot going on. I just finished my mastermind. I have a paid mastermind call that I do every week around 6 p.m. And we were just talking to the guys that are in the course. We were asking, who's doing what. Some people are investing in the UK. Some people are investing here in Ireland. Some people are getting out, and some people are cleaning up, would be the best way to say it. And by cleaning up, what I mean is evicting a tenant that has trashed the place and left it in an awful state. And she was sharing some photographs of what it looks like, and it's absolutely horrendous. In fact, one of the other members said, I think I can beat you, and shared some photographs that he had experienced. And I mean, it's funny how you get a lot of people, like I post in TikTok and I post in Instagram. And once people get an impression that I am a landlord or that I'm kind of like an advocate for landlords, the amount of hate that I get is just insane. And it's like, I don't think it's deserved, because if you saw some of these photographs that people are sharing with me about how their property has been trashed, and yet when they go to try to have this person who's wrecked the place removed, what do? They have rights to stay there for up to 9 months. Well, not that they have rights, but that's how long it takes to remove somebody from the property. If somebody stops paying their rent, for example, you have a mortgage to pay. The bank are not going to give you a big break and say, oh, don't worry about paying the mortgage while you have some trouble with your tenant. The bank are straight onto you, like, what's the story? You got to pay this. And so it's only natural that you get kind of stressed and you say, okay, how am I going to pay the mortgage unless this guy pays the rent? So what's the first thing you do? You contact the person, you say, what's the story? Why is the rent not paid? And they might turn around and say, oh, listen, I'm having a difficult time. And like, don't get me wrong, I'm not kind of oblivious to the fact that people can have difficult financial situation, and they might be sort of saying, listen, I need some more time. I didn't get paid on time this month, or whatever it might be. And that's fair enough. But what you don't want to do is blow smoke up someone's ass, where you say, oh, listen, I'll get you paid next week. And then really all you're doing is like kicking it down the can down the road, and you don't really intend to pay them at all. I've had situations where a tenant, they miss a month and they say, listen, I'm really sorry, I'll pay you 2 months next month. And you kind of give them the benefit of the doubt. And then 2 months, the next month passes, and next minute you're waiting for the 2 months of pay. And of course, if they were struggling to pay a month's rent, what makes you think that they're going to have an easier time paying 2 months now instead of 1 month? So this is one of the difficulties that you have to prepare yourself for. And so just anyway, I'm not giving out about, like, people have difficult times. We've had situations, even in the commercial side of things. If you have a building rented to a tenant who's using it as maybe an office or something like that, and they come along and they say, listen, we've lost a big contract, we're in some difficult situation here, we really, really need you to give us a break. And naturally enough, we got this after COVID started. And if COVID was a very, very unusual situation. So somebody comes along and says, listen, our entire market has collapsed. We are in deep financial trouble here. Can you please just give us some sort of break or assistance, or at least, kind of just understand the situation that we're in. If somebody comes and says that to me, I am not going to throw a blind ear to that. I'm going to say, absolutely, let's sit down, let's try and work it out. But what happens a lot of the time is people just take advantage. And we had a situation where somebody came to us and said, listen, the market has changed, we're in deep trouble. And I said, okay, great. Happy to chat with you, try to kind of figure this thing out. Can you show us your latest set of financial accounts, please? And they're like, oh, you want to see our financial accounts? And I said, yeah. Well, like, just demonstrate to me that show me that you really are struggling with this, and I'll be very happy to talk to you about a solution. And then they kind of back away. They're not so keen for you to see their financial accounts. And of course, financial accounts can be presented online anyway. Like you have certain dates where you have to submit them and things like that. And also, in the case of some companies, they have to publish their results. And so while this person was telling us that they had difficulty because of COVID, we were able to go online and we were able to find that their CEO had just announced their financial results, and it was the best quarter that they had ever had, and that he was just declared a big dividend payment to all their shareholders. And so on the one side of the house, they're saying, this is the most amazing time ever. On the other side of the house, they're kind of pleading, oh, listen, things are really bad. And this is what happens. So you've really got to be careful that the way that the philosophy I have is that if somebody is in trouble, I'll try to help them. But if somebody is pretending that they're in trouble in order to kind of hoodwink me, then they're not going to get a huge amount of sympathy. And so that's the way it worked. We had another situation. We actually learned the hard way. Is because somebody came to us, and it was around about the time of the big financial crash of 2008. They told us that they were in deep trouble, and it was pretty obvious that everybody was in deep trouble back then. So it wasn't a situation where you kind of go, these guys are trying to hoodwink. They were in the sector that was very badly hit. And so clearly everyone was going through trouble. So we kind of said, look, we'll definitely have to help these guys out. So we decided that we would cut them a bit of slack, reduce the rent for a period of time. And what they did with that bit of assistance, though, was kind of sickening. As it turns out that they made a big, huge payment of that amount that they were going to pay to us in rent. Instead of paying it to rent, they turned around and said, right, guys, we got this break, and let's pay all of ourselves. So the top directors and shareholders of the business, they paid themselves a big lump sum out. And those directors were individually using it to sort out their own financial stuff that was going wrong at home. But then they started laying off staff and saying that they didn't have any money to cover staff salaries and stuff. And so, unbeknownst to the staff were being let go, whilst the directors got a huge big payout. And so once we saw that happen, we realized, okay, not going to let that happen again. And we basically always sit down, say, let's go through your accounts. Let's just make sure that we can see what the problem is. Is it a loss of income? Is it a loss of, whatever it is? And that way you just get them to kind of like show, believe, but confirm that, just confirm to us. We believe you, but please just confirm to us. And so anyway, anybody, if you have any questions on property related stuff, I'm happy to go and take those questions. I have my usual bag of tricks here where I can open up some stories to go through. I usually go through the papers and I look for property related news. One of the things that I was going to talk about this evening was just the way the stock market took a massive crash the other day. And all that anybody was talking about was the stock market down 6% in a day and all this kind of stuff. And of course, whenever it's happening, it's pretty frightening for the people that have money there, and they're like thinking, oh my God, I got to get out and stuff like that. But you've also got to remember that your news source that you're getting this information from, the media themselves, they are guilty almost always of hyping up things worse than they actually are. And so if you think about it from the point of view of CNN, I was looking at the headline on CNN, and it was like in big black writing, big black headlines, worst day on market. and then smaller just below, like since 2022. And I was thinking, but that's just like 2 years ago. Like, what's the big deal? It's like, so the market has been going up for the last 2 years, and now it fell today, and it's the worst market since the last time it had a bit of a fall. Not really a proper headline. Hello from Bosnia. That's fabulous. Nice to see you. Nice of you to join us. And by the way, guys, that's actually a great idea. Why don't you just put in the chat there where you are from, and it would be interested to know just whereabouts in the country or whereabouts in the world that you're watching in from. I always enjoy that. So here we have a question from Nicholas Redden. Nama bought last cottage on East Wall for 600 grand off an old lady death and then resold for 12 million. Wow. Yeah, I don't know about that particular deal, but I do know that you can be in the right place at the right time. And watching from Wimbledon, watching from Brazil. Hey, guys. Nice to see you guys. Yeah, like you really timing, like property. One of the biggest things about property is just the incredible swings in fortune you can have if you're lucky and if you're not lucky. And I'll go through watching from Sarajevo. Wow, that's pretty cool. I'm going to go and I'm going to keep on reading out. Anyone who tells me where they're watching in from, I'll be happy to read that comment out, because that's I get a kick out of this. New York, cool. Go New York. So I owned a property in New York about 10 years ago, and really enjoyed going. In London, welcome, Liam. Good to see you. So guys, yeah, we're talking about property and the stuff that can go on. So I looked at a property deal about, I don't know, it was probably around 2010, 2011, something like that. And I can remember this is what the worst time in the market. You can't imagine a worse time. Like everyone was just running for the hills. Nobody was touching property. So of course, any property that is sold during a time like that, if you can buy it, and that is, you know, you can just, and I actually read a comment here, like the City West Hotel, you mean, bought for 22 million pounds, now worth 100 million. Yeah, that's true. And Nick is from Tala. Cool. Yeah, like this is the thing about property deals. So if you, one thing I'm going to tell you is that buying and selling a property, the reality is that somebody is winning and somebody is losing. And it all just depends on your timing. If you go and you sell a property tomorrow and you're selling the property and you get, you know, say it's worth 300,000 and you sell it for 325,000. So you're saying, yes, I made 25,000 more than I was expected to make. So you are the winner in that moment. There's no doubt you got above what you were expecting. However, fast forward 5-6 years, and then the person who bought that property from you, let's say they put it on the market and they sell it for 450,000. Now, does the guy who sold it for 325, who was clapping his back at the time thinking he was a winner, does he think, oh yeah, now I feel like a real winner? Of course, he's going to feel like he sold too early and he should have bloody well hung on to it. And look, this guy's come along and he's made another 125 grand or whatever. And so that's the way it goes. But then it works the other way as well. The guy who buys for 450, he thinks that he's, you know, doing great buying it because maybe it was valued at 475. And so the guy thinks he's bought it at a bargain. And fast forward a couple of years, maybe the interest rates go up, property prices come down, usually when the interest rates go up. And what happens, of course, you go put the property on the market in a couple of years' time. Maybe you're not happy about the interest rates being higher. The payments that you're making are above where you had hoped they would be. So you decide, let's sell the property, let's get out. And now it's back at 350. And so you're taking a loss. So the kind of the moral of the story, I guess, is that money is not really made or lost. It's just transferred. Somebody is the winner for a period of time until they're proven that they sold too early. Or somebody is the person who's buying it and goes and loses money. And so clearly they bought at the wrong time. And so that's the way. If you put all of your money into a single property deal, then you're going to ride that wave either up or down, and you're going to pay the price for that. And so that's one of the reasons why people would suggest that it's better to diversify. And, you know, you can diversify your investments in terms of property. You can diversify into a couple of locations and a couple of different types of property, a couple of different types of tenants, Or you could diversify insofar as I'm going to put 20% of my money into the stock market. I'll put 20% into cash. I'll put 20% into property. Maybe I'll have a little bit of money sitting in crypto or something like that. Like, who knows? But the bottom line is you've got to kind of think about where you're going to park your money so that you have the best chance of surviving in the event that there is some sort of a downturn. And if there is a downturn, you don't want to be the person that has absolutely no money. You want to be the person that can actually weather the storm, because whenever there's a massive downturn, and who knows, that might not happen, or it might be around the corner. Like, it all depends. You're looking at this after the stock market crashed the other day, everyone was talking about how the American economy looks to be in a pretty bad shape and stuff. And so what's that going to mean? And suddenly everyone was all nervous and stuff. And then 24 hours later, bounces back, all the, and this is the way it works. It's like people are just so emotional that they get, that fear kind of creeps in. They get really nervous and they say, I got to get out. I got to get out. And so they get out, and then they find that just as the moment they got out, people were piling back in. And so the market kind of, so you got to be careful. As Warren Buffett is famous for saying, like, just be comfortable with whatever you're buying. Just stick it away in a drawer. Just the piece of paper that says you own it, stick it in a drawer. Don't look at it for 10 years. That's the kind of thing. The Matrix is like a dollar bill bet. Yeah, it's true. So Rich Dad, Poor Dad. Yeah, absolutely. Thinking of buying to rent, is it worth in the long run? Wexford area, I would say, is probably, I mean, it depends. Now, obviously, you got to check prices at the moment, but certainly the people that I know that are buying in that area seem to be getting some good yields. And your yield is basically, the return that you're getting on the price that you pay. And if you consider that you're buying something and let's say you're collecting at a 15% yield, which I know people are collecting in that kind of area, 15% yield, and your interest rates are maybe 6 or 7%. So you can see there's a margin there that you've got more coming in than you are paying out, which is good. But if you buy that same size property in the Dublin area, the yield will probably be closer to kind of 4 or 5%. And if it's only 4 or 5% and you're paying 6 or 7, you can see that you're actually having to prop up the investment. So it's not a great way to do it. I see a couple of comments coming in here. I'll try and keep track of them. In life, you buy when you want to buy and sell when it's your time to sell. Yeah, that's very good philosophy. But the reality is that when you want to sell, it can be the worst possible time to be selling. So you got to be careful. You've got to be in a situation where you don't have to sell. If you have to sell something, that puts you in a pretty bad position, because people that are purchasing, they tend to smell they smell the blood, I guess. I remember in 2010, 2011, I was really heavily in debt because of the crash. And I can remember I was being forced to sell a property by the banks. And I can remember I bought this property for, maybe 2 million euro. And the banks wanted me to sell it. And I said, this is the worst possible time to sell. You can't force me to sell it now. Please don't. And they told me either I sold it voluntarily or they will appoint a receiver to sell it on me. So put it on the market and got an offer of 785 grand. And so over $1 million loss. And I can remember just thinking to myself, my God, why would you make me sell it at this price? But that's the way. So if you were looking around for property and you had money that you were able to raise, pay cash, whatever it was, like if you had saved up or if you had pooled your resources with some other people, you could have bought that property for 725,000. And then today, that same property is probably worth 2.5, 3 million today. And so, massive, massive gains. And that's the thing is it's a game of luck. You're in the right place at the right time, or you're in the wrong place at the right time, at the wrong time. And I got burnt, and I was one of those guys that did really, really well before, and then I was one of those guys that got caught. So I've seen both sides of it, and it's not a pleasant place to be when you're getting caught. It feels great when everything is going well. Let's have a look for more. Rich Dad, Poor Dad. Is now a good time to buy? It is now a good time to buy a house, first time buyer. I would say, like, the thing is for what in a sense, if you're buying it for yourself to live in for many, many years to come, then I would say go for it, because I honestly think probably it'll be more expensive down the road. The way the market is looking at the moment is that interest rates will most probably start to fall at some stage in the near future, especially because of what happened in the stock market the other day. The big crash that took place on Monday was because America's economy is looking like it might be a little bit weak, or certainly weaker than it has looked. And if that happens, then what's going to happen is interest rates will probably be reduced in order to try to kind of like build momentum back into the market. And of course, as soon as interest rates fall, you can watch prices will start to tick back up again. And that's just the way it works. Now, it doesn't happen overnight. You have to be able to sort of sit there and weather the storm. But it will be interesting to see how it plays out. Everyone was anticipating, and this is the funny thing about the stock market, like at least with property, it moves. I mean, this may be a good thing or a bad thing. Property moves slower. And because property moves slower, you have time to think about it. Whereas the stock market, it's like literally milliseconds, people are like deciding to sell something. And I've seen situations where you're there and the stock market is, somebody comes out with a bit of news that says, oh, the results are a little bit lower than anticipated. Just watch it. Like the prices are falling straight away. People are sell. At least for property, you don't have it like that. But the thing about the stock market is they're selling and they're all piling out of the market and everyone's losing their shirt. And then suddenly overnight something changes and they say, hold on, because the stock market is falling, the Federal Reserve will probably lower interest rates. And so if interest rates are lowered, that means the market will go up. Quick, pile back into the market. And that's what happens then. And so suddenly it's back up again. And I don't even know, I haven't been tracking it today, but I'm going to open it up now. And I bet you like all of the losses that happened on Monday are probably already back on us, And so this is the kind of ironic thing about it. I go into Yahoo Finance and you'll find what's the latest going on in the market. And it always amuses me just how fickle people are, that the news that made them sell on Monday is associated with the news that makes them buy on Tuesday. Stocks flip to losses as comeback loses steam. Okay, so we've gone right around the corner. The sell-off on Monday has come back now, and we're going back again. We're going backwards again. So there you go. Another thing that's losing money at the moment is the artificial intelligence trade. It's a lot of people, and this has happened. I can remember when this happened back in the 90s or the early 2000s, when the internet was a new thing, and everyone was kind of talking about the internet. Whoa, the internet! Like, what the hell is this? And like, here we all are. I'm talking to you I'm on TikTok, I'm on Instagram, I'm on YouTube, and all of this stuff is going on through the internet. And yet, back when it came out, people were like saying, it's just a fad. This will pass. Nobody's going to be buying and selling stuff online. You can't trust your credit card online. And that was the view. And so what happened was the big hype and everything went flying up, and Amazon was one of the companies that went flying up at the time. And then suddenly what's known as a hype curve shoots up. Everyone's amazed that this technology exists and it's going to transform the world. Same with, crypto and all these things. And then suddenly people go, hold on a second, this is going to take a while for it to roll out. This is not maybe as big of an opportunity as we thought it was, or maybe we're going to have to invest billions in order to kind of see it through to the full opportunity. And suddenly then it kind of falls off. And so it goes up to the hype, then it falls down, and then it peters out. And then what happens is it slowly starts to kind of like recover. And that's probably what's going to happen now with artificial intelligence. Everyone was piling in, and NVIDIA and all these stocks that are involved in AI, they all went berserk. And fast forward a bit of time, and suddenly it's, there's a little bit of the hype has come off it. So it'll be interesting to see how it all plays out. We have a question here. Let me see if I can read it. Okay, yes. I'm moving home and have money for a deposit for a second house. Is this a good option? With tax on rent, it feels people are selling up as no gains to be made on owning a house from rental and capital gains. Well, it depends really. A lot of people buy and they kind of, I was talking to one of my mastermind members the other day, and he bought a property a couple of years ago, and I was asking him, like, what was the decision matrix you went through? Like, how did you decide to buy that property? What decisions did you make? Was it based on yield or income or capital gain? Like, what were you thinking when you bought it? And he was like, honestly, Gavin, I just thought that I can afford this. That's about as far as he could really take the decision making. It was like, I have a deposit of so much, I can afford this. And that's as far as it went. And that's the problem, I think, with people, is they don't, when somebody asks a question, is it a good time to buy or not? Like, every day is a good time to buy if you find a good bargain. Every day is a bad time to buy if you're staring at something that's massively overpriced. So you really got to be very careful. You've got to look at the surrounding area. You got to decide, am I buying at a similar price, or am I buying at a higher price or a lower price to the stuff that's for sale in the area? Like, don't just go and say, okay, this is on the market at this price, and so I guess that's what it costs. Do your homework. Look around, have a look. Usually you can go online. There's a property price register. You can see how much properties have sold in recent times in that area, and you can find, oh, okay, something sold for that amount. And then you can look at it against yours and say, well, I'm going to have a look. Go online, see if you can find some of the maybe the brochure, the online brochure, or the agent's website. Maybe it's still listed there or whatever. Maybe you can find some photographs of the thing, and you can see, okay, that's in a much better condition than my property, so I'm going to discount mine back a little bit. And you can kind of work out. Also, look at the rents. What are you going to collect in rent from that property? If you're looking at it to buy for yourself, it's obviously a different calculation. But if you're looking at it and you're thinking that I'm going to buy this and I'm going to rent this, the first thing you've got to think about is, what's your mortgage going to be? How much can you raise? And then once you know what you can raise, and it's based on, I think it's 4.5 times whatever your income is, there's going to be an interest rate that they charge. And the interest rate is going to be, usually it's quoted by the banks, and they'll say, 6.25% or whatever it might be. Yes, I'm losing some hair. Thank you for pointing that out. Well done. What do you think of Forex trading? I would say Forex, if you know what you're doing, loads of money to be made. But the vast majority of people I know don't have the emotional fortitude to do that. What I mean by that is, you go through these emotions, and it's like, oh my God, the stock market is going, and suddenly, like, the emotions catch you, and you might sell. And if you had just waited half an hour, maybe the price would have come back. So getting back to the property thing. So you're looking around at the properties, you're looking at whether or not what you're thinking about buying represents good value compared to what's been sold before or after in that area. And then what you do is you look at the rents. You say, I'm buying this property and I'm buying it at X, and I'm going to be able to collect so much of rent. Now, what happens is, if you're in Ireland, Daft is a good place to go in. You'll be able to go in there and you'll be able to see that, they'll tell you what the rent is in that area. And the other thing is, a good trick that we've used inside our mastermind is just to create like a dummy ad and just put it up there and say, here's the street, here's the type of property, and put it up there to rent, and put it up there at a range of 2 or 3 prices. Say you have like a couple of bedrooms or something like that, and you say, there's a double room with an ensuite, here's the price. And what will happen is, somebody will click on that and they'll say, I'm interested. And the more of those that you get, that that's a good price. But the less, if you find that you're only getting 1 or 2 clicks, then it's probably a little bit too pricey. And so that's one of the ways to kind of test it. So the price you're roughly being asked to pay is either good or bad value. What the rents are getting in that area. And if you go and take the rent and divide it by the price, that'll give you your yield. Usually it gives you a percentage, so you have to multiply whatever you got by 100. But if you've got, like, say, a 10% yield, that's pretty good. If you've got a 15% yield, it's great. If you're getting a 5% yield, then no, a dummy ad is not misleading if you're not actually renting it. All you're doing is trying to create information. You're trying to collect data. So I'm not saying put up a dummy ad and then like rent something that doesn't exist. I'm saying put up a dummy ad just to test the market. Like, where is the market? If what you're like, let's say, for example, you have a 3-bedroom house and you cannot find like what a 3-bedroom house rents for in the area. You just can't find any information. How are you going to know what you're likely to collect? So what you might do is you might say, okay, let's start at 1,500 a month. And then let's start at 2,500 a month. And let's start at another, and so you've got 2 prices there and you put it out there. And if you find that a lot of people are clicking on the 2,500, then you'll know that, okay, I know that there's definitely a market at that kind of level. But then you just take the ad down and you just say, sorry, it's already gone, or whatever. Like, if somebody is, what you don't want to do is use your email. The big trick is to create like some sort of a Gmail that you don't use, because what you don't want is 500 emails coming in, hey, I'd like to rent the house. You just want to have something that you can kind of collect some data. And that's just a useful way if there is no data. Most of the time you can collect the data. Just go into Daft and it'll tell you that on that street, here's what you can collect. And there's probably already a load of properties in that area for rent, or there recently was. But if there's not, then that's one way of potentially testing the market, just to understand. I know some of the guys that I work with, they've done that more specifically when they're doing a HMO. And so if they're splitting up a house and they're trying to understand how many bedrooms, like say you have a 6-bedroom HMO and you're going to rent it out room by room, you might be thinking, what can I hope to get for it? And you might be thinking, should I make it, en suite, or should I just have it with a shared bathroom? And so you go and you put the different prices out there in a dummy ad, and it'll come back, and it'll, like, what we would do is we'd put some photographs that we've borrowed from another job, just so that you have something that looks kind of nice, and say, here's potentially a house coming up. We have an ensuite, double room. This is what it costs. And then we also have we have a room with no ensuite, just with a shared bathroom. And then you see how much interest there is in both. And if you were to find that nobody clicks on the ad where there's a shared bathroom, well, then you have a fairly good indication that if you go and come out with a house with a shared bathroom, that you're going to have very little interest in it, but you'll have loads of people interested in the ensuite. So it just means that you now understand that I definitely have to put the money into putting in that ensuite, or else I'm going to have difficulty shifting the property. Of course, we have a massive housing shortage now at the moment. So in a sense, all of these tricks are for in a more normal market. When the market is like this, like you're going to rent almost anything. Sorry to say, but that's just the reality. And there is people out there that will try and rent anything. Some comments in this live were filtered to protect the community's experience. I don't know. Was somebody using bad language? Maybe they were. I'm going to just check and see if there's any. If I gave you 50K to make money, what would it be right now? That is a difficult question. I mean, 50K, what's your time frame? You see, this is the thing. People say, I'm going to give you 50K. Do you want the money back tomorrow? Or are you going to give it to me for 5 years? Because those two choices will dictate. Like, if you give me 50 grand and I buy a property with that 50 grand, I'm probably going to have to get out a mortgage. I'm probably going to have to pay stamp duty and legal fees and various things like that. So the 50 grand, you'll probably find that if you were to buy and sell the property in the space of a month, you might actually have lost a fair bit of money, because all of those expenses, you haven't had a chance to recoup them. Whereas you might be able to buy 50 grand's worth if you're willing to run the risk, put 50 grand into the stock market, or in the downturn that happened on Monday, you might have bought 50 grand's worth of stocks and shares on Monday, and then on Tuesday sold it all, and maybe you'd be up 70 grand just in a day. That's possible. But you could also be looking at 30 grand left in your bank account. And so this is the thing. You really have to think about it from the point of view of what's your time horizon for the investment and how long, how much risk are you willing to tolerate? Like there's people that would say, I'm putting all 50 grand into crypto. And that, you know, crypto, some of the time, crypto has done incredibly well. I mean, if you bought crypto back when it first came out, you'd be a billionaire today, kind of. But the reality is some people went and thought that crypto was going to go to 500,000 and they bought crypto at 65,000 and then it fell to like 50,000 or something like that. And then it, like, if you look at the movement of Bitcoin in the last couple of years, there's times when it's gone from up to 70,000 and then it's fallen down to 15,000. So clearly the guy bought at 70 and now is sitting on a 15 grand loss. He's going to be sorry, but that 15 is a great opportunity for everyone else to pile in. So there you go. I mean, it really depends. Like, this is the problem is that people are looking for simple answers to complex questions. So it's not always easy. There's a lot of questions coming in now. Let me see if I can get through. Is it correct to say that the rent you will get, it will effectively be halved after income tax? Well, yes, it depends. What you're allowed, when you rent a property, you can offset the interest that you're paying on your loan. So you take out a mortgage and you have so much interest on the loan. You deduct that first, and then whatever profit is left over, then that goes into your tax accounting. And so there will be a deduction from that. Now, there's other ways that you can invest, though. People invest through a company. I know somebody who's investing through their pension. And I can tell you, if you have the ability to create a pension fund, like if you own your own company, for example, and I think I probably did a podcast about this a while back. You can, if you own, say if you're a plumber or an electrician or a carpenter or anything at all, and you have your own small business, then you're able to go and put all of the profits that you make into your pension. And every penny that you put into your pension means that the tax your company will pay reduces to zero. And so then you have a big pot of money sitting in your pension. If you buy a house with that pension money, no tax at all on any rent. And if you double your money and sell the house for twice what you paid for it, no tax on the capital gain. So pension is the absolutely best way to go. But there are some restrictions. First of all, you can't borrow as much money in a pension. You can borrow, but it's not like most people when they're buying, they have to buy money. They have to buy using a mortgage. And usually it's maybe the amount that they're buying, they maybe want to raise like 70% of the price of the property. If you're buying it for your home, you can buy up to 90%. And but if it's for an investment, usually the banks will max out around 70. So you have to come up with 30% yourself. And so that's the first thing. The 70% that you've gone and borrowed, there's interest on that, and that's going to reduce the amount that you have to pay tax on. So that's the way to do it. When you invest through the pension, you're only going to be able to go maybe 50%. So your pension is going to have a lot more sitting in it for you to be able to do that. But it's definitely, if you're thinking about buying something and locking it away for years and years and years, that's the way to look at it. Lock it away in a pension and just pay no tax whatsoever, and just forget about it until you are until you're old, and then you'll have a great property sitting there, no tax. I'll give you an example. I bought my first property in 1993, and I bought a Mews house in Ballsbridge, and I paid 85,000 Irish pounds for it. Now, Irish pounds, probably the conversion to euro is probably about 105,000 euro. And I rented that property. I lived in it for 5 or 6 years, and then I rented it to a guy. And the guy who I rented it to lived in it for 18 years, paid me rent for 18 years. And in the time that he paid me rent, he paid me 3 times what I purchased the property for. That's how much rent I collected, 3 times more than I paid for the property. So if you own something for a long time, you can do really, really well. And like if it's a nice area, if it's a good, now you might have to spend some money over those years, renovating it or doing sort of certain jobs. Some tenants, like it's unusual. In my case, I found this very nice chap who was quite eccentric, and he wanted to rent the place from me, and he just never even considered ever moving on to another property. He was just so happy there. 18 years. And it was only when I was selling the property that I had to ask him to leave. And he didn't even want to leave. He was asking me, could he buy it? And I was kind of saying, well, of course, if you want to buy it, if you want to pay what these guys are willing to pay, then I'll sell it to you instead. And he didn't want to do that, because the guys that I owned the house next door as well, and the guys that I was selling to were wanted to buy both. So I lost that great tenant, but just 18 years of paying rent, like, just fabulous. So holding it on long term, that's the way to go. So let's see. And if you're going to hold it on long term, well, then doesn't it make sense to just park it in a pension and just have that money accumulating for years and years and years? That's the way I kind of look at it, you know. Now, it's different. People will have different views. If you decide that I want to get into property because I would like to have the extra income every month coming in from the surplus that I get. So that is often what happens with property, is that you buy and let's say you find a property, you buy it, and you're going to earn 2,000 a month, but your mortgage payments every month might only be 1,000 a month. So you've just created an additional 1,000 a month profit that you can take for yourself. Now you're going to have to pay tax on it, but the income that you earn from your job, you also have to pay tax on. So what's the difference, in a sense? So that's a way. Like one of my clients in my group that I do the mentoring with, he's only a young guy. He's 26 now, but when he joined my group, he was only 24, and he bought first property, started creating a nice surplus like I've described. So he bought a second property, and now he's got the two of them creating a surplus. And so he was able to buy a car and things like that. Then he went and he did what's known as a rent-to-rent deal. Now, those of you who don't understand what a rent-to-rent deal is, it's possible for you to go out and rent a property from somebody. Let's say you come to me and you say, Gavin, I want to rent your property at 2,000 a month. And I say, grand, but you're taking on all the headaches. I don't want any calls. I don't want to have any hassle. And you say, that's grand, no problem. But all I want you to give me the permission to do is to sublet that property. And I say, grand, go ahead. So you turn around and you're paying me 2,000 a month, but you're going and you're putting that property on, say, Airbnb, and you're getting 700 every weekend for that property. So now suddenly you've created 2,800, or maybe in a long one of those weeks, where one of those months where you have 5 weeks, maybe you're able to get 3,500 in a month from that property, but you're only paying me the 2,000. You haven't bought the property. You're just literally renting it to rent it. That's why they call it rent to rent. Explain again, if one has a small company or a business, how do I finance a property within the company and pay no tax or rent? It's not, you have to put it in a pension. So the way it works, Cathal, is that if you have your own company, and a lot of people who are, would say, plumber or electrician or carpenter or anything like that, anybody who works with their hands and is in the trade, usually you'll set up a company and it'll be XYZ Limited, whatever. That company is putting out you're doing services and people are paying you for it. So the money is coming into the business, and anything that any money that comes into the business that you don't pay out to yourself is a profit. That profit is going to be taxed at 12.5% in the company. But the alternative, instead of paying 12.5%, is that, and instead of paying yourself the amount of money that you're paying yourself, and you're paying 50% tax on that, what you do is you say, I'm going to create a self-administered pension. And that means that you've got basically this fund that sits beside your company, and you're able to take as much money as you can afford in your business and put it into that pension. And that then becomes, first of all, any profits that you have in your company fall by the amount that you put into the pension. But once the money is in the pension, it's hard to get it back. Like, you're meant to leave it there until you're in your 50s or 60s, but it sits in there completely tax-free. Anything you buy, if you buy a property with that money, it's completely tax-free. All of the rent that you earn from the property, tax-free. And if you buy the property and sell it for double, Normally you'd have to pay capital gains tax, no capital gains tax in a pension. So it's a wonderful way to invest, although it's not for everyone, because not everyone wants to lock money, not lock property away or income away for 30 years. But if you want to make sure, like, probably the smartest thing to do for everyone listening who's younger, the smartest thing to do would be to start your pension now when you're young, and just park a certain amount of money into savings and things like that you have access to today, but do 50% into your pension. And that way, if you get into that habit, I have a friend who did that from a young age, and the guy now lives like a king, just has this like pension that is absolutely stocked with so much. He just has so much income that he's traveling all the time, and he just lives this amazing life. And that's because he has a massive pension and doesn't pay any tax. And then when he turned 60, he was able to kind of get access to all of it. And so it's just a nice way to hedge your bets. Like, a lot of people say, it's no use to me waiting until I'm 60. But when you get to 60, suddenly you'd be like, oh, I'm glad that I did. Now 60 is just around the corner. I'm able to do it. And a lot of people that are in the trades will find that they, you've got loads of energy. You're as strong as an ox when you're younger. But then as you get older, like, who wants to be on a building site in your 50s? When it's cold and stuff like that, you start getting, people will get arthritis and things as they get a bit older and stuff. You don't want to be earning on a site. You would much prefer to have a fairly well-stocked pension or something like that that's going to allow you to sort of sit back a little bit. Anyway, somebody says, Nick, you say that 56K Bitcoin today, it'll hit 100K. Yeah. At 56, like, that's a bargain. Like, if you think about it, it went up to 75 there recently enough. So have you built any hotels? I have built one hotel. I've built one, and I did a planning in Dubai for a second, but I never built it. But the first one we built, yeah. Is it correct to say the rent will be effectively halved? Oh, sorry, I'm reading the same comment. Okay, so I'm a student with about 4K. Good ROI from my stocks. Any other ideas? What should I go for a good ROI? Like, it depends. I wouldn't want to be giving people specific advice. What I would suggest, though, is, if you're willing to lose it, then maybe put a small amount of that aside and sort of stick it into Bitcoin or something like that. Like, who knows? Maybe you'll double your money on that. You could also lose it, so be careful. Or you might not lose on Bitcoin, but maybe it'll go down another bit. And so you might actually be nursing a bit of a loss. Is it too late to set up a company after purchasing a property? Yes, unfortunately, it's too late once you've done that. The way it works with pensions is that it's very, very restrictive. You cannot self-trade and stuff. So if you own a property and you own a pension, you can't sell the property to your pension. That's self-trading, basically. So there's all sorts of restrictions around that. And also, you can't manage a property yourself if it's in your pension. It needs to be, as they call it, an arm's length transaction. It needs to be very much that this is a property that you bought, that you're going to put it in the hands of a letting agent. The letting agent will collect the money and put it into the pension, and that's it. What they don't want is people fiddling the pension, and that is where you're saying, oh yeah, I'm only getting 1,000 a month, and really you're getting $2,000, and half of it's going to into cash, like into your back pocket or whatever. So let's have a look at the next one. I'm being invited to join a live as a guest. Have I ever invested money with trading? I've done a lot of trading, and I paid a hefty price. So I'll tell you my story when it comes to trading. And this is where one of the things that I always say, like, I can tell you all these stories now, having experienced this, and boy, was I stupid doing certain things. But when you're young and when you've made some money, you suddenly feel like you can do anything. And it's very easy to kind of screw up because your emotions get in the way and your ego gets in the way and stuff. So I'd done some really, really well on a couple of deals, and I had about 200 grand sitting in the bank account. And I remember having lunch with a friend of mine, and my friend had done really well on the stock market. And I can remember, I knew that people invested in the stock market, and I had a few, some shares myself, but I didn't ever go more than like maybe 20 grand or 30 grand in stocks and shares. This guy was telling me that he had invested in, I think it was Ryanair or something like that, and he had bought in September, and we were having lunch in March, and he was up 40 grand or something like that. And I remember thinking, hold on a second, 6 months, 40 grand. How did you do that? And he explained to me that there's a thing called CFDs. CFDs are called contracts for difference. And I was like, whoa, tell me more. I need to know about this. And so a contracts for difference is a mechanism that traders use. And that is where if you've got 100 grand sitting there, you can put it into a CFD account and you effectively have $1 million to invest now. And of course it's at risk, but basically you can invest up to $1 million into the stock market with your 100 grand sitting in the bank account. And the way it works is at the end of every day, you are credited or you are deducted whatever profit you made or loss you made during that day. And so I remember my friend basically, instead of, he put so much into the CFD account and he bought something like 400 grand's worth of Ryanair, and Ryanair went up by this amount, and then he sold all 400, it went up to 440. So it only went up 10%, but the 400 grand went up to 440. So when he sold it, he had now 40 grand sitting in his bank account. And I just remember thinking, what, you can do that? So I rang up my broker. I said, I want to do a CFD account. And he sent me out all these documents, and the documents are all you signing your life away. The documents are you saying, if you make losses, you're going to be responsible, blah, 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 all this stuff. Yeah, no problem. Sign away all that. Just give me the account with that kind of leverage. And so I took 100 grand, put it into this account. Now I had $1 million. And I just said, okay, I'm going to buy various stocks. And I can remember I bought a gold mining company and I bought an oil exploration company. And if I can remember correctly, one was called Glencar Resources. And the other one was, I can't remember the name of it. It was Glencar and I can't remember. It'll come to me. But these two companies I put, and I can remember I kept on investing more and more and more. And what happened was the 100 grand I put in, every day, if the stock market goes up, you can see that you have like a profit. It tells you that you have this extra profit. So in the first day alone, I was up like 2,500. The second day I was up 5,000. A week later, it was telling me that I was already up 10,000 in a week. And I remember thinking, this is amazing. And I went like that. And then there was some good news came out about the gold company, and it went up. And in a day, it went up like 100 grand. And so at the end of the day, I was looking at my account and I was up from 100 grand. I was now at 200 grand. So I'd made 100,000 profit in like maybe 3 weeks or something like that. And it went on like this. And I can just remember thinking, this is incredible. And it went on like that. And I held it for another few months, and I went up as high as 850 grand. And I can remember thinking to myself, I am a genius. I have put 100 grand into this account, and now I have 850 grand profit. And so what I said to myself was, okay, I'm going to ride this wave until it hits $1 million. And then as soon as it hits $1 million, I'll cash out and I'm going to go and buy myself a nice brand new Porsche 911. And that's going to be my gift to myself, but I'll just keep the rest as and save it or whatever. So that was my sensible idea. And anyway, sure enough, what happened? Never hit $1 million. Stock market got into a bit of a wobble, and the whole thing came crashing down. And I can remember the 850. That was the peak that it reached. And then the next day, I sort of saw that it was now at 770. And then I was thinking, okay, look, I'll wait till it gets to 850 and then I'll cash out. And then instead of going up, it went down, and it was at 710. And I'm like, damn, okay, well, look, I'll wait till tomorrow, wait till it goes back up a little bit, and then I'll just cash out. And that's the way it goes. It's like trying to catch a falling knife, down, down, down. Anyway, I followed it down. I kept on thinking that the market's got to turn at some point. The market has got to turn. And it never did. It went down, down, down. It went down to back to the 100 I was at. And then I thought, no, I can't exit at the amount that I got in. I've got to wait for it to go back to where it was. And the only thing is it didn't stop. That's the problem with CFDs. It can go negative on you because it's all leveraged. And so it actually went 250 negative. It went 150 negative. And so I was losing a total of 250. And so the guys actually said to me, the way it works with CFD is if you do make a loss, that evening they want you to settle the loss. And it didn't happen initially. I think my first loss was like 30 grand. and they called me, Gavin, sorry, but you've lost 30 grand today. You need to go and pay that money in. So I paid the money in. And if you don't pay it in, they sell your entire shareholding. So you'll take a full, you'll basically have no shares left and you'll owe the 30 grand. So I thought, okay, I'll pay the 30 grand. Hopefully it'll bounce back tomorrow. And instead of it going and bouncing back, the guy's calling me again. Sorry, Gavin, it's down another 40 grand. You need to put the money in. And I remember at this stage, I was kind of thinking, this is a disaster. How can I have gone from 850 to now I'm about to put another 40 in on top of the 30. So I'm now 70 negative. And then the next day was my birthday. And I went down to this beach club. I was in Spain at the time, went to this beach club and was sitting by the pool, playing with my kids, and phone is ringing, and it's the guy, the CFD guy. And I was just like, well, F him, I'm not going to pick up the phone on my birthday. And so I didn't pick it up. And of course, then it's working on your head like, oh shit, what's the message he's leaving? What's he going to say? So went and checked the message, and it's Gavin. You had a bit of a messy day today. It's down another 70 grand. You need to put the 70 in today and on your birthday. And I can remember thinking, that's about 150 negative I'm going to be at. And I just said, you know what? I can't keep doing this. I can't keep chasing this thing. And I just rang him up and I said, and it was my birthday, rang him up and I just said, sell the whole effing lot. I don't want to know ever again about CFDs. And that is the way it works. If you get into this gambling and you think that money, and this is what I saw with everyone that was getting into crypto at the time. I can remember guys buying new cars and new watches and all that kind of stuff. And I had been through all that. So I could see it. And I just knew this will end in tears, because that's what happens, is that people think that it's perfectly normal to make enough money to buy a Rolex in a weekend. And then when they wonder what's gone wrong, when suddenly, the market crashes and you lose all your money. Like, how many people had money in FTX or whatever with your man Sam Bankman-Fried, Question from Ted. I have 400K in the bank. If I buy a house and do it up and sell it again and repeat this, could you retire? Well, there's a big question there. Like, it all depends. First of all, is there can you retire on, how much money do you need a year? If you have 400 grand today, and you need 80 grand a year to survive, well, then it's only going to last you 5 years. If you can survive on 40 grand a year, it's going to last you 10 years. But you're going to be eating into that amount of money. What age are you? If you're going to live into your 80s and you're 70, well, maybe that works. But if you're going to live into your 80s and you're only 50, then you've got 30 years to get. Are you going to have enough money? So 400K sounds like a lot of money, but if it's going to fund a retirement, it's not enough. And so you really need to try to do better than that. What you can do, what I've done before, and this is another hack in terms of money, ways of making money without having to pay tax, is just your own private residence. You don't pay any tax on profits on your private residence. And so what I've done over the years is, and I did it a few times, is that you buy a property and, and it's a home that you want to buy for yourself, but you buy it and it's in a poor condition. You do it up really nice job on it, do it so that it's something that somebody would like to move into themselves, and then you put it on the market, and every penny that you make on that property is tax-free, and then you go and put it into the next project that's kind of similar. Now, as a single man, it's easy to do that, and you can kind of put up with the living on a bit of a building site and things like that, and it's a way to kind of really make some good money for a while. But if you have a family, then there's only one or two more times you do that before your missus will be fairly unhappy with you, and so there's a shelf life. It's fine maybe as a couple, but if you've got children, then suddenly it's not really viable. Living on a building site, first of all, but second of all, people like to have like a back garden for the kids or whatever. How can I go about getting investment capital to renovate and flip properties? That's not so easy to do. Now, that is something that I have a mentoring program, and I teach people how to raise money from investors and stuff. But it's not just as simple as that. You have to kind of like build a bit of a profile for yourself. Like, an investor is not just going to come along and say, oh, here's money. You've got to do a little bit of advance work in order to make that possible. So think about it like this. If I said here now on this call, guys, I want money, I want to invest in property and I'd like to take your money to go and do that. Would you be all like saying, oh, falling over yourselves, here's money for you? The reality is you're going to want to know more details. You're going to know a little bit of background check about me. This is the kind of thing. So if you go out there and start speaking to somebody and they've never heard of you, there's a whole lot of education that you've got to, they're going to have to figure out, do I know this person? First of all, they do a search in you online. So what's your profile look online? The second thing is they're looking at your track record. If you're saying that I'm going to do up this property, I'm going to flip it. Have you done that before with your own money? If you have, how many times have you done it? If you've done it multiple times and you can prove that, look, I know what I'm doing. Here's the project I did. What I would do in your situation is I would have a load of sheets of paper with photographs printed on it of before, and here's the project after. And then what you do is at the bottom, you might do a list of purchase it for this price. Here's how much I spent on the refurb, how much we sold it for, profit, bang. That's really simple. Onto this one, looked like this. Here's what it looks like finished. And then say, bought for this, sold for this. Now, if you do it like that, and you do that enough times, you're going to be convincing to somebody. You're going to sort of say, the guy's going to say, okay, you know what you're doing. Okay, that's great. Now, explain to me how the deal works. And then you have to explain, okay, I'm going to ask you to give me 50 grand, 100 grand, whatever it might be. I'm going to be buying the property. I'm going to be using the bank's money to purchase the property. But what I need from you is the money I'm going to spend doing it up. And when the house is done up, I'm going to sell it. And there's going to be a profit made, and then I'll give you back your money and I'll have made my profit. That might be the way you explain it. So what's the guy going to earn? If he's giving you 100 grand and he's putting his money on at risk, what does he hope to get back? You would probably want to be offering him maybe 110 grand back if he's giving you the money for a year, we'll say. Like 10% would be, kind of like what people would expect to earn, because they are risking the money putting it with you. Of course, you can go to the bank and you can borrow it for cheaper than that, but they're going to make you jump through more hoops and stuff. So that's one of the ways, like this, and I've probably simplified it a bit there. Like you also have to know how to present the numbers and all that, but that's a way to do it, It's funny, TikTok does this where it asks, it's going to shut down the call unless I do this little thing here. Now we're back. So guys, you guys over in Instagram are very quiet. I don't have any questions, but the TikTok guys are asking tons of questions. So let's go on to the next one. Do you know Maplewood Construction? Yes, I do know who they are. I don't know much about them, but I've definitely seen stuff about them before in the papers and stuff. Do you know much about the 8-year ETF rule? I've heard of it, and I know I'm tied up in some stuff that has a similar kind of 8-year taxation event and things like that, but like don't ask me specifics about that kind of stuff. Like really what I do is I look at lots of different opportunities, and then I'll bring in like a professional that understands all that. Like one of the things to understand is the laws, the rules change, the regulations change, the laws change, and it's probably best to work with kind of a professional who knows their way. A professional will be up to date with all of the rules and stuff. Like I studied architecture. I am technically an architect, but I don't practice anymore. And I don't practice because way back in, when it was at 2000, it was 1997, I bought a property and I used my architectural, I qualified in 1997. And in 1999, I bought a property. I got planning permission on that property and I sold it. And the property I bought, it was a site. I bought it for 25 grand. It was in the west coast of Ireland. And I got planning permission to put 4 houses on it. And then I tried to find a builder first of all. And I asked an auctioneer to introduce me to builders. And instead of introducing me to builders, he came back with an offer to buy the site from a builder. And I was like, well, I'm not really interested in selling, but what's the offer? And my 25 grand that I paid for it, this guy was prepared to give me 125. So for me, it was like, my God, like that's crazy, because it was only a few months since I had bought it. So from my perspective, I suddenly said, whoa, architecture is a mug's game. Like I'm getting into property full time. And that was how I looked at it. But I always thought the good thing is the architecture's up there. I can use, I know how to design, I know how to build a house, I know how to do all that stuff. But the stuff that does my head in that I just have no patience for is the rules and regulations. Like, is it 220 millimeters of a step, a riser on a staircase, or is it 230? Like, I don't know right now, and I don't really give a shit, because I'm just going to get my architect to go and tell me, and he'll have read all those latest updates of the regulations. Instagram question: best approach in starting a property portfolio. What is the best bank for it? Well, there's like banks, there's a lot of different banks out there, but if you're going to start a portfolio, then maybe the bank is not the way to go. Like, you're going to buy a property using a bank, yes, but what you're probably going to want to do, the problem I found is that you're going to look at deals, and as you start getting into property deals, you're going to find that you're looking at a property and you buy it and you're doing that one up, but you're still looking in the market. You're always looking, and another opportunity will come along, and you'll be like, crap, now I can't do anything. Like, this is the perfect job for me to move on to, but I need to secure it, but I'm doing this. So what you need is really to have a little bit of extra capital. And I found the best way to do that is work with either partners or investors. And partners are nearly easier. So what I'd be doing is, I used to kind of go out there and say, look, I'm doing a deal here. Would you want to come in 50-50? And that way I'd keep some money back for the next deal. And my partner would say, yeah, absolutely, I'll go in for you with you 50-50. So we did that deal, and that deal did really well. Yes, I had to share my money with my partner, but I still had money for the next deal that came along. How do you find a partner? That is a good question. Like that, you got to be careful about that. And it doesn't, it's not always easy to find a partner, because if you go and find a mate who you went to school with and you know the person really well, that can be a good business partner, because you kind of know them for years and all that. But it's always a good idea, even if you know somebody like the back of your, like really, really well, it's always good to have, how do you trust them? You have to put some sort of contract in place. So what I would do is what we did, I did this already with a good friend, well, a friend that I didn't know that well at the time, but we've gone through the wars together, and I know now that I can trust him really, really well, because we went through really difficult times and we didn't turn on one another. We were both, honorable. And so that's kind of the best partner. But I've seen others where people just turn on you and they basically say, right, I'm off, and you're stuck with the debt. Like, people declare bankruptcy and you're stuck with their share of the debt and stuff like that, How do you find a partner? So you do that carefully. Like, you do that, you don't be doing that in a rush. But somebody, like, say, for example, if you're in the trades business and you're an electrician, like, a great partner to have might be somebody who is a plumber. And so the two of you can kind of like take on a job together. You can both put in your time, and maybe you both have some equal amount of savings. So you can buy a place, do it up together. You can call in your mates to do the other stuff that you don't do, and then you've added the value. That's the big thing about investing in property. I don't think buying a property and renting it is enough, because you'll barely cover your cost of your mortgage payment. What you want to do is buy a place that you can add significant value to. And how do you do that? Well, you buy it if it's in a really bad state, you have to fix it up. And so you do it up, you do the kitchen, do the bathrooms, repaint the place, carpets. Maybe a lot of the time now, people are doing an improvement in the energy performance. So when you buy a property nowadays, you have a BER number, and that is the energy performance. If you can get that energy performance up, you can actually add quite a bit of value to the property. And a lot of the banks nowadays will happily fund a property that has a higher BER. They're not so quick to fund something that has a lower BER. Okay, let's see. Paying 2,200 per month in cash to build my house should take 10 years. My dad keeps saying, get a mortgage and rent it out. Thoughts? In cash to build my house. You see, it all depends. Like, what you've got to think about with this is, what's the opportunity cost? If you're paying 2,200 a month in cash to build your house, it's going to take you 10 years. That's a long time. If you just got a mortgage, you could have the thing done much, much quicker. Like, a lot of people have this kind of attitude that I don't want to borrow any money from the banks. But the reality is it is a way to get from A to B much quicker. You can buy a place for 100 grand and add 50 grand of renovation work to it, and then that property might be revalued at 200. So you've created 50 grand out of thin air. Now, if you did that with the bank's money, that 100 grand, you're doing great. But if you borrowed 100 grand, put in 50 of your own, and now you created another 50, and you give the bank back their money, that why would you take 10 years to do something that you can do in a space of a pretty quick couple of months or something like that? So that's a way to look at it, but you do have to be careful that you don't overextend yourself with the banks. Does the loan amount increase after each loan? Yes, it can do. Well, it's not that it increases, it's always down to your ability to pay. But if you've bought a property, done and proven to the bank that you fully repaid the loan, they start to see you as a safer bet. And so you build up kind of a credit score, and the banks will look at you and say, oh, this is a good guy, like bought before, paid every penny back, so we're comfortable lending him money. Whereas if you've bought something and you haven't paid it back, or you've struggled to pay it back and you've delayed and stuff, it does go down as a black mark. But ultimately, the bank are not going to suddenly go and jump up to another level unless you can demonstrate that the deal works and that you're going to be able to pay it. How do you trust them? Yeah, contract. Best investment plan I can do for my child. That's a good one. Like something long term. Like I would have thought, if you're thinking about buying property, that's one thing. But if you're thinking about your child, sometimes the best investments are really just parking money in the stock market at a rate of like €30 a week, and just have it on a direct debit into a savings account, and then it just goes into the stock market automatically. That's called dollar averaging or whatever. So instead of buying €1,000 of shares, you just buy €30 every week. Another €30, please, another 30. And you just do that gradually over time. And you'd be amazed the amount of people who've done that. And 10 years later, like they've quadrupled their money or something like that. But it's done very, very gently. And if you can just forget about it, then it really, like I've done that before. I bought something in a pension, and I bought a load of stock market shares, and I completely forgot about it. I went abroad. I spent 10 years, with all these kind of problems with the banks chasing me and stuff like that. And I didn't look at my pension for all those years. And then I came back, and I can remember one day opening up all this old posts that built up in my house. And I was like, oh, look, pension. It was a report from my pension. I had forgotten that I even had this thing. And I went and looked, and the shares that I had bought in Kingspan for 25 grand were worth 240 grand or something like that. They'd gone up like 10x in that 10-year period. And I'd completely forgotten that I had this. And suddenly, whoa, pension, like sitting there full of cash. That's the best way. Whereas if I'd been aware that I had that money there, even as it was smaller amount growing, you might be tempted to go, oh, I'll go in and I'll start trading and I'll start doing this and that. And a lot of the time, your emotions get the handle. You say, oh, I must go and buy this share, and you buy something, and then it posts the loss the next day, and you sell it. And you end up like in and out, in and out, in and out, and it goes nowhere. Whereas sometimes the best thing is just park it and forget it and just do nothing. Live in Dubai. That's a nice spot. Is it a good idea to buy in Dubai and then move home and then buy another in Ireland? Well, there's a couple of guys that I know. First of all, I have a school friend that I went to school with this guy. He's an agent now, a real estate agent in Dubai. I think he sells residential property and stuff, new build. And so he's a great guy. I'm actually going to get him on the podcast, and we're going to talk about Dubai property and stuff. But I was in Dubai after the 2008 crash, and Dubai suffered quite like other people, like other places. And I can remember what happened actually, what was really interesting, and you don't see this frequently, but in Dubai, those countries in the Middle East, if you cash a check and it bounces, your next stop is jail. It's against the law to bounce a check in Dubai or in any of those kind of Middle Eastern kind of countries. And so if you go and like the lifestyle in Dubai can be pretty amazing. I can remember looking at buying a really nice car, like a top of the line Audi S or S5 or something like that. And I can remember the cost of that was only going to be, $300 a month or something like that. And I can remember thinking, wow, that's like the same comparison in Ireland, it would have been like 2.5 times that or something like that, 3 times that maybe. And so it seemed like a really good bargain. And they extend you the money to do this. But if you lose your job and you're unable to make a payment on that car, you're going to jail. And so when I remember going to the airport, and I remember parking my rental car in the airport car park, and I was just going away for a day or two and I was coming back. I remember walking around, and there was all these Porsches and Lamborghinis and really fancy cars covered in thick dust, and they'd been sitting there since the 2008 crash. As soon as people lost their jobs, it's drive the car to the airport, park it, and leave the keys in the ignition even, and just go straight in and just get on the next flight and leave the country. And that is because they knew that they lost their job, they wouldn't be able to make the next payment on the car, and so you're better off getting out of the country than to stay there and face the music. And so that's what I saw, like, and literally dozens of cars like that, you know. So Dubai, yeah, great place. I have a friend, actually a guy in my mastermind, and he is living in the Middle East, in the Dubai or Abu Dhabi area, and he actually is making a good salary there, and he's investing it back here in Ireland because you earn money tax-free over there. And so he's earning decent money, and he's actually able to make nice savings and then just send it home. So he's buying stuff back home. Best investment is but a house in flats. Yeah, this is great advice, Gavin. Thank you very much. Thanks. How much do you need to get into buying commercial property? Well, that's a very hard question to answer straight away. Like if you find commercial property is anything that is not residential property. So it's essentially you go and find a place that could be rented, we'll say, to a cafe or a phone shop or something. That is commercial property. And so commercial property in that situation could be very cheap. Like you might be able to buy it for 200 grand or something like that and rent it to somebody, and that person will pay you 2 grand a month or whatever in rent. And so that's it. But you can go to humongous heights as well and stuff. Yes, on top of commercial property, what are your thoughts on BidX? Well, BidX, great place, great transparency. Obviously, you can see stuff and you can go and buy it very quickly. I know somebody actually who was looking at a property on BidX and was sitting in the airport and was thinking to himself, I like that. I like the look of that place. And so he put in a bid, and then he jumped on the plane and flew to Dublin. And when he got off the plane, he turned on his phone, and the first message he got in was that you're successful, the property's yours. And so that's the way to obviously do it, you know. Let's have a look at some of the TikTok questions. So we have quite a lot here have built up. So let me see. Buy Ryanair and oil, yeah. That's the carry trade is a bad position, yeah, for sure. What's the story about new pension scheme that is coming to Ireland 2025? I actually don't know enough about that, so I can't say, but definitely read up on all that. Like pension is essentially free money with restrictions. But like if you can live, if you're a disciplined enough person, it's a guaranteed way to amass a fortune. Because like if every penny you earn is taxed either as income tax or capital gains tax or any of this stuff, then it goes without saying that every penny you make, it's reduced by the tax. And so you make more, it's reduced by the tax. Whereas if you're in this other vehicle that's just going up, 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 never taxed, you can imagine how you can accumulate much, much faster. What developments, what did you work at? So I'm a part of a group called Earlsford, and Earlsford is, we've built East Point Business Park, and I run East Point Business Park, and I look after the commercial portfolio there. So I look after a lot of the office buildings. It's not doing great at the moment, I can say, because a lot of people nowadays prefer to work from home and stuff. So it's a difficult market at the moment. At least residential market is pretty hot by comparison to the commercial market. But I do see people are talking about the, if you're thinking about we'll say, back in 2005, the stuff that I was doing that I was making really good money was to buy a neighborhood center and fill it with just shops. Like at the time, video stores were the thing. So you know, nowadays we have Netflix, but back in those days, you went to the shop in the corner, and you got a video cassette, and you put it into your cassette player. And so there was an Extravision store where you went and you'd pay $4.50 for a video or whatever, and the next day you'd bring it back. Those were that was a bonanza. Like those places made so much money back in the day. So I can remember I rented a place to Extravision and thought, this is fantastic. Like, this is the best deal ever. A couple of years later, they've gone bankrupt. So it just shows you that nothing is guaranteed. And so you have to kind of constantly keep your eye out. I've rented to off licenses, and I did a deal back in 2004, and I went past the property recently, and they're still there trading 20 years later. So there's a good example. But I also, in that same complex, I rented to a pizza place, and the place closed down within a year or two. So it shows you some places survive, some places don't. So you got to be judicious about who you rent to, and not just like the brand or whatever, but the individual as well. Like, is he a person who is new to business, or is he a person that is like a seasoned sort of retailer, knows what he's doing? I mean, would banks fund buying commercial properties with 40% down and commercial? Yeah, they would. 40%, I'd say. If you can put 40% down, I think you'll get a deal from. And like, the great thing about commercial property is you can get long leases. So the leases that, like, you don't really see them anymore, but when I started my career, it was quite normal to sign a 35-year lease. And then it became more common to sign a 25-year lease. Nowadays, people would laugh at you if you asked them to sign a 25-year lease. It's more likely 10 years or 15 at the max. But a lot of the time, nobody would touch a 25-year lease anymore. But the market has changed a lot from where it was. So let me see, going down through these comments, there's a good couple more to read. Starbucks is a good stock to buy. Okay, there's a lot of people talking about stocks. Ryanair, definitely a good buy. Okay, so this is becoming an investment advice page. If you were starting out again with 50 to 100 grand, what would you do? Great idea. I'll tell you what I wouldn't do. I wouldn't rush into it. One of the things that I have found is that when you've got money sitting in your pocket, you can find that it's burning a hole in your pocket. I've seen guys with money saved up, and they feel kind of a desperation that they have to invest soon, because if they don't, it's like they're going to miss out on an opportunity. And the thing is that emotion, you got to control yourself. That emotion is dangerous, because first of all, any kind of pressure, if you're investing and you feel a sense of pressure, that's not the ideal way to be investing. What you want to do is invest with patience. You say, you know what, I'm going to go and I'm going to do my research. I'm going to read about this, and I'm going to decide whether it's a good investment or not. Then I'll make my decision. But don't make there's a thing that I like to talk about on my podcast. I talk about cognitive bias. And cognitive bias, there's a lot of different types of cognitive bias, but one of them is called confirmation bias. And that is where you make a decision and then you start researching, is that decision a good idea? And everything that you read, you will want it to support the decision. And so you start looking for information that will confirm it was a good investment. And so, using Ryanair as an example, if I was to say, I want to buy Ryanair, let's go and see how it's doing. And I start looking on the internet and I see something that says Ryanair is shoot for the moon, something like that. I might suddenly going to go, okay, brilliant. That's all I needed to hear. And I might not go and do any more checking, because that confirms what I want. Now, if I happen to stumble across something that says Ryanair, trouble ahead, I might read it, but I might keep reading more, doing more research to find the comments that I do like to hear that say that, yes, you should go and buy that Ryanair share or whatever. So that's confirmation bias. It's where you've made a decision already, and all you're looking to do is to back up that decision. And anybody who does that, if you're not aware of that, it's really dangerous, because I did that buying a property in Spain, and I wanted to buy the property. I decided I was going ahead and buying it. And then I started doing my market research, as opposed to the sensible thing. Do your market research, figure out, like, is it the right decision to do it or not? And then, and only then, make your decision. But don't come to it having made a decision. The other thing is continuity bias. And this is something that we all face, is if the market is currently really, really bad, then people will automatically assume that it's going to continue to be really, really bad. That is just continuity bias. It's your mindset is that, well, it's going to be like this again tomorrow. And that is the reason why markets tend to go in cycles. It's like they all go down because everyone is kind of believing that they're going to continue to go down. And then it's the people that understand that emotion and they can go against it. And they'll sort of say, do you know what? Now is a great time. Now is a bargain. I can see a bargain and I think it's a good time to buy. And so that's what happens. And so those are guys, the contrarians. They'll go and they will invest even when everyone else is selling and trying to get out. They're not caught up in the emotion. And they're basically saying, do you know what? These look really good. Like the stocks look good or whatever it is. The property looks good. I'm going to buy. I don't care like that everyone else is selling. And that's the thing, is a lot of the time people are like, they act in a herd mentality. If you go and say, I'm going to go and buy a property tomorrow, and then everybody you speak to goes, oh, Jesus, are you serious? God, the market's in terrible state. You'd be like, oh God, maybe I shouldn't. But a contrarian will be, that's right. Yeah, it's really bad at the moment. I'm going ahead and doing it. And they have the conviction to go ahead and do that. But it can be difficult to have conviction. You've got to be a confident person to have conviction, because your conviction can be eroded when you buy something and then it continues to fall and you're like, uh-oh, I hope I haven't, shit the bed. And then it goes and it does it again, goes down a bit again. And you start to kind of get a bit shaky and you start wondering, did I screw up here now? But the people with conviction, they can watch it go down. Now, some people are big enough to admit, you know what, I timed it wrong. I'm going to get out. I'm going to take a bit of an L and just, this is a loss. But you've got to be mature enough, if you're going to be investing, that to understand that you're not going to win every single trade. If you think you're going to win every single trade, then you're emotionally immature and you shouldn't be investing. You have to invest knowing that there is a likelihood that something could happen tomorrow. The market could go down, whatever might happen. And so you just need to be careful that you're going into it with your eyes open. And even the most, accomplished traders, they know that there's a possibility that they screwed up and they bought early and then suddenly something happens and they have to get out quickly. Because if you don't get out and you stay in there, you might the market might drop. But equally, they'll know that, no, this is a good trade. I'm expecting it to fall some more while the market stabilizes or whatever. And so it's very hard. Like, this is not an easy game. You have to be really resilient. And I've gone through like massive ups and massive downs. It's very easy to say it now, to you guys who are starting out, and say, be patient and be disciplined. But I know it's a lot harder when you're younger. You're kind of like, come on, let's go. And I remember piling into something. My brother was working in a company and they were all allowed to buy shares in the company. And so every one of them were all buying shares as employees. And the stock was about to be on the market. And because they were all doing it, he told me, it's coming to the market. We're all, mad keen to kind of stay in this investment. So I invested in it. And I remember I think I put in 30 grand. And within the first day of trading, it was up 37 grand. So I was thinking to myself, fabulous. This is like an amazing. And so I took a load more money out of my bank account and I put it in to buy more. So the 30 to 37 was my indication that's going to keep going. So I think I put another 20 grand in. So my total investment was 50 and I was up 57. And I think within 3 months, it was at like 15 or something like that. And basically all of the staff had realized that their boss was getting out. And so they all started selling. And so the prices started crashing. And, you're on the outside looking in. You don't get that information. You don't hear those inside stories and stuff. So it's very hard to know. So you're there thinking you're making a sensible idea, but it's all emotion. So you got to be super careful. Guys, I've got another minute and then I'm calling it off. I do 90-minute call with you guys and it's been great to be on with you. So I'll answer a couple more questions, but then I'm going to call it quits. Do you have any working templates for working out the ROI on a potential property investment? Yes, I do. I do. And I give those to all my guys in my mastermind and my accelerator and stuff. So feel free to reach out and message me if you're interested. All of you watching, let me just, if you want information on investing or anything like that, my voice is gone. I think I've been talking for too long. Write the word invest in a comment below and I'll reach out to you and I'll just send you information if you're interested in joining my mastermind or something like that, if this sounds like of interest. I come on here once a week, talk for 90 minutes. So if you just want to like this, but if you want to get more serious into it and I have like programs and things like that, just write the word invest and I'll reach out to you afterwards. I feel S&P seems like a bit safer bet. Yeah. How do you usually check if a property developer is trustworthy before buying? Well, you know, go and look at their track record. If you look at their website, you'll see lots of other projects and stuff like that. It'll give you an idea, but you know, companies can go under, but hopefully, you know, there's a thing called home bond where when you're investing in property, it has an insurance policy basically. So it's basically, hopefully you're not going to get caught like that. Okay, I'm looking for a final question to ask. Let's have a look. Is 10 to 30 grand enough to get into property, or can you go do less? I'll tell you what, it would be kind of the minimum, but depending on where you buy, like if you're buying in the Dublin area, you won't get anything. But I have one of my clients is in Castlebar, and I think his first investment, he only had 18 grand and he was able to buy a property. And then he was able to buy a second property with the profit he made in that first one. How much do I need to get into commercial? Oh, I think I've done that one before. When does it make sense to form a company if you never plan to sell any of the properties? I'm at 100K. You should get some advice on that. I'm not going to be able to do that here now. We have Neve ask, sorry, Gavin, came on later. Can I ask, is it a good time to buy a house in Ireland? That's a really long answer question. And I answered that last week, I think. If you go into my YouTube channel, Gavin J. Gallagher, you can watch back last week's call. And I did a call like this the week before. I think I answered that. But my view, the market will probably continue to go up. And I explain all of the various factors why I think that. So rather than answer that question right now. Right, guys, 92 of you on the call. I feel bad saying goodnight, but I've got family downstairs, so I'm going to go down and say good night to them and things like that. So, guys, it's been great. Tune in, same time next week, 7:30 evening until 9. And then on Wednesday, I'll do the same again. So talk to you guys next time and really appreciate you joining me here.